Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
When I met you in the summer.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of the Equity Mates Summer Series. This is a podcast where we explore what's possible in the world of investing. If you've just joined the show for the first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. As always, I'm excited. But how could you not be with the experts that we get to speak to on this podcast?
Having a blast.
In this series, we've been unpacking as much as we can from some of the best fund managers and financial advisors in Australia and drawing out those actionable insights that we can apply to our own investing journeys so we can make 2025 our best financial year yet.
Love it. Well, today we are joined by Will Dowd from Fairlight Asset Management. Will is a partner and portfolio manager. He actually started at the firm as an analyst in the investment team back in 2018, but has since moved up into the portfolio manager role. He has over a decade of investment and data analytics experience with prior roles at Evans & Partners and Ernst & Young. And Ren, as you've alluded to, we love getting the guys on from Fairlight because we're always exposed to new ideas in countries as well that we don't often spend a lot of time looking at. So we're really excited to unpack that further with Will today. And full disclosure, we are both invested in the Fairlight Small Caps Fund.
Now, Will joined us for the summer series last year and we unpacked Landstar Trucking Systems, a company that we had never heard of before. And that is a real recurring theme with the team at Fairlight. A lot of unknown and at least unknown for us, unknown and unloved companies that they have developed a real niche in finding.
Yeah.
So unsurprisingly, we'll bring some more to the table today.
He literally brings a book on trucking to the table.
And he put it on the table.
It's his coffee table book. Anyway, before we jump into that and you get a look at the book that he brings into the studio, we want to say a massive thank you to Charlie Viola and the team at Viola Private Wealth for supporting this series. Viola Private Wealth specialise in bespoke financial strategies with expertise in managing alternative investments like private equity and real estate. As managers of over $2.5 billion in assets, they help individuals and families unlock the potential of illiquid assets, adding stability and growth to their portfolios while still holding high quality, diverse portfolios of equities.
Charlie is one of Australia's top financial advisors. He regularly ranks right near the top of the list of top financial advisors in Australia. So if you want to speak to Charlie and the team at Viola Private Wealth, head to violaprivatewealth.com.au.
All right, without further ado, let's bring in Will Dowd. Well, Will, welcome to Equity Mates.
Morning, guys.
So investing is a lifelong journey, something that we are always trying to improve at. We've spoken to you a number of times on the show, and it's always amazing you coming in and giving insight into a wildly new industry or stock that we've never sort of come across before. So what are you working on right now?
Yeah, I think we're at a really interesting period of time at Fairlight, I guess, in the evolution of the business and the portfolio. So we started the business back in 2018. Obviously, returns have been pretty good over that period of time. And we're long-term investors, low turnover, ideal holding period, 5, 10 years, forever, ideally, if we find the right business. And so if you think about our portfolio that started 5 years ago, we've owned a lot of those businesses since we started, but a lot of them have done very well. And so we now have this really interesting dilemma amongst the portfolio of we have these businesses that have done quite well for us. We know them really well, but the fact is they're a lot more expensive than when we bought them 5 or 6 years ago. And so the challenge that we now have is balancing buying a new business that we know less well that might be cheaper versus do we hold on to an existing business that's a little bit more expensive that we know better. And it's actually quite interesting when you think about it because my view is buying is much easier than selling. When you look at a business, you come in from a fairly neutral psychological perspective. You don't have any of the baggage that comes with owning a business for 5 years. And so institutional fund managers are quite good at buying, but they're actually really bad at selling. So there's research that says they're actually better off just selling at random. And so
Really?
yeah, so they destroy a lot of value through their sell decisions. And the reason is it's usually you sell the things that have gone up. So you're selling your winners, which generally you don't want to do, or things that have gone down a lot because there's psychological pain about holding them. And so where we are now, what we're trying to work on or, thinking about a lot is optimizing that balance between buying and selling and trying to really sell well.
What processes do you have, knowing that research is there? What are you trying to build into that process to actually optimize for that?
Yes, we have a few things. First of all, we know one of the things that we do in the portfolio is we know that great businesses tend to compound out faster than you think. And so where we have identified a really great business that's done really, really well, we will give it more leeway to run from a valuation perspective before we start selling it. And so essentially we have a small cohort in the portfolio of really high quality businesses that can get a little bit expensive, but we know that over time they tend to compound out faster than you think. And especially a lot of these businesses, you're only one result away from earnings going up 20 or 30%, and then your valuation comes down from 30 times, 25 times, it becomes a lot more reasonable. So that's kind of how we work on that. And then the second thing actually that I'm working on kind of on a learning perspective, I guess that's the business on one side, but then on a more personal side, I've recently read this book, Die with Zero, which I think was really interesting.
Yeah.
And thought-provoking. So it talks about balancing everything in life is a trade-off between money, time, and health, really.
Yeah.
When you're young, you've got no money, but a lot of time in your health. When you're old, you've got much higher earning capacity, much more money. You don't have your health, you don't have your time. So, for example, you're not going to be able to go rock climbing when you're 80. And is being the richest person in the nursing home a life well lived? Maybe not. And so it talks about being more thoughtful about making those trade-offs between sacrifices now in terms of the time and money, and in my life trying to think about how to balance that better.
So you're not doing wineries in Italy for holidays, you're jumping out of airplanes? Is that is that how you approach it?
Well, actually, I just did a cycling holiday in Italy, actually, which was one of the best things I've done.
Awesome.
So kind of a good reminder to do experiences and pursue those things definitely while you're young. So, balance in all things. I guess I'm definitely much more on the save hard, start compounding early. You know what I mean? When I was 16, I was scrounging every dollar to try and invest.
Yeah.
And so that's all good and well, but maybe there's a balance in everything.
Yeah.
Interesting.
Nice. Love that. Well, if we bring it back to investing, I think one thing we always appreciate when, you or Nick or anyone from Fairlight comes in, you always have really interesting and quite niche companies. It might be an Asian tool maker, it might be an American trucking company, it might be, a European maker of some widget that we've never heard of before. And we're really interested to understand how you, develop the level of knowledge and expertise in these different geographies and different industries that you require to then make an investment decision. So can you talk us through your process? You come across a company that might have interesting numbers, but you know nothing about the industry or, the competitive landscape. What's your process to sort of learn and upskill?
Mm-hmm. So I guess I'll preface this by saying the types of companies that we are looking for, and the way our investment process works is we are very vigilant around our circle of competence and what we do and don't know. And ultimately, any company that is going to require us to spend 6 months learning chemistry or rockets or, any kind of incredibly complex topic is actually, we would just screen that out and say that it's too difficult. And so an important thing here is for us as investors at Fairlight is we're not aiming to have an informational edge on other people, or we don't go out to try to get superior investment results by knowing more or being smarter than other people, because we don't think we're good enough to do it. What we want to do is have a decision-making edge. So the idea is that we can take all the information that everybody else can and then make a better decision using that information. And so that being said, when you think about the businesses we own, so, one of the largest paint manufacturers in the US, trucking companies, which we've talked about before, things like online classifieds, all these businesses ultimately, making and selling paint is not that complex. And so that's the reality of it. Yeah. And so when you want to learn about that business, yes, we still need to go and learn the business. We still need to go and learn the industry and do all the due diligence, but there's a lot of resources available. The companies make it very easy. You can go and speak to the companies, speak to competitors. Just, there's a lot of free resources out there. We also subscribe to a lot of expert calls and third-party things like that. But what I'm trying to get to here is, I wouldn't say that what we're doing is going out and becoming real niche experts on things and that's how we're generating our edge. It's really not that hard to get a reasonable level of understanding of the US paint market to then make a reasonable investment decision around it.
I think just to follow up on that, like the challenge there is actually properly defining your circle of competence and stuff like that. And I feel like that's where a lot of people go wrong. They decide NVIDIA's ripping and that they can understand, semiconductors and GPUs and stuff like that. How do you discipline yourself to not give yourself a bit of scope creep there?
Mm-hmm. It's one of the hardest things we do. And I think that's where you've really got to lean on an investment team. And that's, why our team at Fairlight is so important. And so you want to spend a lot of time, or we've spent a lot of time up front defining very specifically what we will and won't invest in. And so it's industrials, niche technology, healthcare, some consumer discretionary, consumer staples. And so we're very strict on that. And then you are then really, because human nature is, you see something interesting and it happens incrementally and slowly over time. So it's not like you go one day, here's a circle competence, and then you're way out of it. It happens in very small increments over, say, 3 or 4 years. And then all of a sudden you realize your portfolio has changed a lot and you're really, you're exposed in such a way that you didn't intend to. And so that's why having that discipline and having your team around you that can remind you of, you bring this stock to the table and then your team says, well, hold on, we're starting to push out of these barriers. And then also, because it happens incrementally and slowly, it's really important to be very disciplined about not letting it, even a small deviation outside of the circle can then lead to a bigger one afterwards. So those the factors.
Nice.
So we're witnessing a pretty remarkable year for markets at the moment. We've seen the acceleration post-US election. Crypto is booming. There's obviously a great sense of optimism and obviously the markets are responding accordingly. So how are you thinking about taking advantage of that opportunity versus managing risk on the other side?
So at Fairlight, first and foremost, everything we do is with a lens of reducing risk. The reason for that is our view is the best thing you can do to increase your rate of compounding is reduce the number of mistakes you make. Rule number 1, don't lose money, essentially. So for us, the first thing we think about is reducing risk. And so to your point, in this environment where things are definitely looking, when we think about the pendulum of market mood at the moment, you would say it's closer to enthusiasm than fear. And so that's something that we definitely keep in mind. But for context, we don't do market timing at Fairlight. We don't think we can. We don't believe in it. And so we intend to stay fully invested all the time. So you kind of go, well, how can we balance those two things? We want to proceed with caution whilst also we're not going to make a macro view and go tonight and sell half our stocks because we think the market as a whole is expensive. So what we do within that is spend a lot of time thinking about the valuations of our stocks and making sure that we have a lot of discipline in selling those businesses when they get too expensive and then trying to find cheaper alternatives. And so the focus for us, especially over the last 2 to 4 weeks, but the last few months as well, is really looking over our portfolio and going, okay, where are these businesses delving into excessive enthusiasm, optimism, where the valuation isn't justified anymore. And so a good example that I can actually tell you about is Old Dominion. So
not only can Will tell us about it,
show us the book.
If you're watching on YouTube, he's brought a prop for us.
Yeah. So
not any prop, your coffee book.
This is my number one coffee table book. Which I guess goes to show the kind of person you need to be an analyst. But anyway, I love this book. But
I love this book.
Old Dominion's been around for 100 years. It's a trucking company. It does less than truckload trucking. So if you think about if you're a small industrial business in the US and you're making some kind of widget and you need to move it around, you don't want to hire an entire truck because you've only got a pallet. So there's companies that cater to that. And so you can think about these guys, they've got 500 distribution centers scattered around the US. Trucks go around, pick up the pallet, you go to the distribution center. They're all sorted, moved to another truck that then drives it to another distribution center, then is delivered on the other side. Sounds simple, but it's actually incredibly complex. It's quite a concentrated industry. only 4 or 5 players. And the reason for that is as you get bigger, you get more scale, you can reduce costs. So it's just a real scale game. So interestingly, when we think about balancing opportunity and risk, so Old Dominion highly leveraged to local manufacturing in the US. So obviously with the news that's come out over the last 2 to 4 weeks, people are getting particularly excited about increasing tariffs, increasing domestic manufacturing. This is great news for this company. The challenge is the market knows it. So I think on the night of the election, the stock was up 10%. It's up more since then. And so then talking about our process as well, we look at this and we go, this is a really high quality business. It's been around for 100 years. It's got a 30% operating margin, 30% returns on capital. It's compounded EPS at 25% per annum for as far as I can see. It's a terrific business. It's now trading on 35, 36 times earnings. And the fact is that this business has to spend a lot of its money every year buying more trucks and distribution centers. So this isn't a technology business, right? The cash conversion is low because you've got to invest in the business. And so you've got 35 times low cash conversion earnings. That might work out. You could have paid that historically and you would have done fine. But when we look at this and then stack it up against the rest of our portfolio, it's one of the most expensive businesses. And so we've been selling this business over the last couple of weeks. And that's a reflection of kind of that managing the risk. We don't think there's a margin of safety here in this business anymore. We still love it, but not at any price.
Nice.
Just in terms of portfolio construction, you said you're 100% invested. So does that mean if there's any opportunities that pop up, that you don't have any sort of dry powder, you are selling positions like this to take opportunity?
That's right.
Yeah, right.
Yeah. So we have flexibility. If we have made a big mistake and we need to sell a business because we've got thesis drift, there's no rule that says that we need to stay 100% invested. We can hold some cash there and wait for the right opportunity to arise, but we are not going into cash to try and time markets. And we just know that probabilistically, I mean, our fund has done 13% per annum for the last 6 years. So if we were holding 10% cash, that's a 2% drag to our returns every year.
Yeah.
And so it just doesn't make sense. From a probabilistically, you're just better off to stay fully invested.
Yeah.
I just had a look at Old Dominion. In my lifetime, it's done 28,000%. And so once again, I'm reminded, why wasn't I investing, from day one?
That's it.
28,000%.
Yeah, not bad for a trucking company, hey?
Yeah.
Wow.
Yeah. And one of the things that's so great is it's so simple. And management know exactly what they have this playbook and they've been doing, you read this and they've been doing exactly the same thing that they were doing in 1960 that they're doing now. And they deliver great service. So they're the best provider. They put their prices up 3 to 5% every year. But because they have got the best on-time delivery, none of the packages get damaged. Customers ultimately come back to them because they've got the premium provider. They can price for it. And then they just invest that into more distribution centers, more trucks, better service. And this flywheel just runs. And they're just by far the best.
Well, Will, I'm sure we'll talk about other stocks in the portfolio or other stocks that are interesting to you throughout the conversation. But we want to turn to a bit about your story, I guess, and sort of how you got to where you are and the lessons you learned along the way. So take us back to the beginning. What was your introduction to investing?
So I was, in hindsight, very lucky that I had a lot of good influences around me that set me on the right track. So specifically, very thankful to my dad to be a really good influence, setting me up with a high interest savings account when I was 10 and, learning about compound interest and all those kinds of things. And then I was actually very lucky as well. He had a subscription to the stock newsletter, The Intelligent Investor. I'm not sure if you're familiar with those guys.
Yeah.
And so that used to come in every fortnight and I'd read that when I was 16 or 17. And I think they actually do a really fantastic job of writing educational content, but also teaching people like the value investing philosophy, long-term investing, fundamental investing, these kinds of things. And so it was interesting, actually, that dates back to kind of 2005, 2006. And so my first investment, I was working at KFC at the time, earning $6.30 per hour, and I saved up $1,000. That's a lot of Zinger burgers. And then the guys in Intelligent Investor probably won't like me bring this up, but anyway, based on their recommendation, I bought a business called Timber Corp. Now, I'm not sure if you're familiar with this, but this was in 2007, went through the GFC, the stock went down 99%.
Wow.
Yeah. So my first investment was a complete wipeout. Anyway, that didn't do enough to dissuade me from the path. So I actually then was doing data analytics as a career and investing on the side just as a hobby. And I think that's actually really important. I just wanted to read everything I could get my hands on. So, Fisher, Lynch, Howard Marks, Buffett, all these kinds of things, and just reading everything I could. And then trying to put those lessons into practice myself, and just investing myself and trying to teach myself. And then I realized, oh, hold on, I actually
you're really good.
No, well, not about that. I'd lost 100% of my first go, but no, I just had a huge passion for it. I was like, I love this.
Yeah, nice.
This is amazing. And then did a Master of Finance, did my CFA, and then got a job as an analyst. And then that was a decade ago. Here we are.
Nice.
It's interesting when you talk to people, those who have kind of followed the passion and taught themselves versus kind of people who've gone through the traditional pathways of just, doing commerce or economics or uni or whatever. And I find, the ability to the passion to really go and do it yourself, read all the books, teach yourself, and then put it in practice, invest yourself is invaluable.
Yeah. Two parts to the story that I certainly resonate with. One, I also used to work at KFC as my first job, $7 an hour. I didn't invest the money though. I bought a drum kit. So long-term investment.
Yeah, based on our previous discussion on a time experience, you might have made a much better decision buying the drum kit than I did.
And secondly, I think your story, it kind of captures what Ren and I try and say a lot on the show, is that you don't need a background in finance or, the formal ways of getting into the industry. Like you can, and you're a reflection of this, actually just teach yourself and then find people to learn from, and lo and behold, become a good investor. So,
absolutely.
Yeah. Are there any lessons from those early days that, you look back on and still hold to yourself today?
Mm-hmm. One that I do think about a lot, I remember when I read Peter Lynch's book, I'm not sure you guys are familiar with it, but he talks
on Wall Street.
He talks about that concept of scuttlebutt investing. So that's where, you talk to people that know the company, or you go and use the product yourself to go and figure out if it's a good investment or not. And he talks about, back in the 70s or 80s when he was visiting companies, he used to stay in this particular motel all the time. I think like La Quinta Motor Inn, and it ended up being a 100-bagger, I think, for him. And he just figured it out because he was like, well, the service is the best and they're everywhere. And I think that idea of when you're investing, of understanding the product and understanding the company and figuring out, is it a good product? What do people like about it? What don't they like about it? Because I think it really brings you back to, it's easy investing to think about kind of the abstract nature of a stock or a chart or, the numbers, but to really bring it back to the tangible nature of this business makes this product and sells it for this through, this shop, and I like it for X, Y, Z reasons. And that tends to be, if you follow, that process, you stay out of trouble because the business is adding value somewhere.
Yeah. The story from One Up on Wall Street that sticks with me is the stockings story. His wife was buying stockings from the supermarket, and that was the start of his investment process, and it was another big winner for him. So aside from One Up on Wall Street, which I agree is one of the best investing books, what are some of the best resources that you came across in that time that you'd love more self-taught investors to read?
Investors, we've never had more information available to us, right? And we're actually in, I think, a bit of a golden age because so many people will put their things on the internet for free.
Yeah, which is both a blessing and a curse, because then all the signal gets lost in the noise.
Exactly,
as well.
Which is what I was going to talk about, which is it's then the big challenge is trying to figure out what actually has value and what doesn't have value. And I guess it's really hard. And this is where I was so lucky to have people who, push me down the right paths. Because if you're just starting out, you have no idea what the right path is, and you could head down, some
crypto TikTok.
Exactly. I mean, this is all my opinion, but trying to trade based on charts and day trading and all this kind of stuff. And, it can take you years and you have to lose a lot of money before you figure out that doesn't really work. But yeah, I think now there's an amazing amount of resources, but I guess you really need to start with someone that you trust, and then branch out from there by looking at kind of the content that they have. But I know we were chatting the other day and we talked about Jason Zweig on the Wall Street Journal. He's a phenomenal author. And so, a great starting point would be go to his Twitter and look at who he follows. Because, I trust what he says and what he looks at. And then those people are then publishing a lot of really amazing investing content as well. I guess this is more for the investor who wants to pick their own stocks and do the research. I should say, your average person who just needs to do an index fund portfolio, you don't need to be going to these lengths. But if you have that passion, love for investing, then definitely there's a lot of stuff out there on the internet. But I would just say, to your point, just be careful. You just need to be careful about, because you ultimately don't know who's writing it on the other side of it. So
and if you are going to follow Will's advice and go and look at people like Jason Zweig or perhaps Morgan Housel on Twitter, a recommendation: make sure you flick to your Twitter feed to following rather than for you, it'll save you a lot of brain rot.
Yeah,
Nice.
absolutely. Yeah, that tab's banned. I think.
Yeah, good.
Yeah.
Will, we're just going to pause here for a second to say a massive thank you to Viola Private Wealth for sponsoring this series. Illiquid investments offer unique opportunities for wealth creation. Viola Private Wealth integrates these assets into diversified portfolios, leveraging decades of investment expertise to ensure they align with your financial goals and risk profile. If you want to find out more, head to violaprivatewealth.com.au. Welcome back to Equity Mates. Today we're talking with Will Dowd, partner and portfolio manager at Fairlight Asset Management. We've loved speaking to Fairlight over the Equity Mates journey. Yourself and Nick Cregan always got really interesting insights and really interesting companies. Today's been no different. You've literally brought the book on Old Dominion trucking, and I'm sure we're going to get into more companies that you're investing in this part of the conversation, because we want to turn to your investment philosophy. And, from European whatever makers to American trucking companies to everything in between, it can be hard to, I guess, look at all the companies that you own and tie them together and say, what's the through line across them all? So what is your investment philosophy at Fairlight, and what unites all these disparate companies?
Yeah, I think if you just wanted to boil it down simply, it's really 3 steps. Find great businesses, don't overpay, buy them at reasonable prices, go to the beach, do nothing.
The third step is actually the most important.
And maybe the most difficult as well.
Yeah.
And so each of those 3 things, they sound simple, and maybe each one on their own might be easy, but I think doing all 3 together for a long time with discipline is actually quite hard. And that's kind of the real tough part about investing. And so I guess if we kind of step through each of those 3 things to kind of understand what we do. So finding great businesses. So for us at Fairlight, true north is always return on capital. So we want a business that's generating at least, the cost of capital. So, call it 6 to 10% per annum on its assets for many decades. The reason for that is we know if you have a business that's susceptible to competition, eventually people will move in, they'll compete away any excess return, and you'll see that in the track record of the business. We also have a bunch of other checklists that look across kind of the quality of the industry. So we want growing industries that are not overly competitive, looking at the quality of management, looking at the quality of the financials, operating margins, these kinds of things, but primarily looking for high return on capital businesses that have a track record of doing that for many decades. And so that part itself, I wouldn't say it's easy, but it's not like that's an incredibly difficult thing to go and do. In fact, today you can run screens and analysis. You could just spit out every company on the SP 500 or in the US and just filter by certain metrics, and you could get a pretty good idea of what a list of quality companies are. That's not that difficult. But the challenge though is if everybody knows a business is great, it's priced that way, and then you're not going to generate a great return. So really the thing that makes investing hard is that you can buy the world's best business at the wrong price and do badly. Conversely, you could buy the world's worst business at the right price and do really well. And it's that kind of balance between those 2 things that makes investing so difficult sometimes, is you've got to get that second order thinking right. And so that's the second part, which is not overpaying and the discipline of making sure we have a valuation for each business so we know what we think it's worth, and then staying true to that. So when the market is coming to us and saying, we'll offer you a lot more than what you think it's worth, then you can sell it back. Conversely, if we can buy it from the market a lot cheaper, then we do that as well. That discipline on not overpaying, having a valuation, and then, how do we find those businesses cheap? Generally, for some reason, they're underappreciated by the market. So this is kind of, where the hard bit is as well, is you need to go and find businesses that for some reason, for whatever reason that year, the market hates the trucking industry. And that happens. It goes through cycles. Earlier this year, we were able to buy Old Dominion at a cheap price because the market had just thrown out the entire industry. And so that's what we're looking for, kind of opportunities where we can buy a great business, but at a reasonable price. And it's quite hard to get those 2 things. And then the last part, again, maybe the most difficult, is the doing nothing. And so we're long-term investors. We've owned nearly half our portfolio since we started. And the worst thing you can do is, if you've found a great business, you bought it at a reasonable price, don't interrupt the compounding process. You got to let it go and do its thing for you. So as soon as you start trading too much, taxes, brokerage, and then, trying to switch in and out of things, invariably you often miss a lot of the upside. But that sounds easy to do, but in the day-to-day of coming into work every day, you've got headlines about the economy, you've got headlines about, various industries. Sometimes the discipline of doing nothing is really, really difficult.
So just on that doing nothing, like how many new positions would you guys initiate in a year? Anywhere
between, say, 3 and 10. So the easiest way to think about it is we've got 35 stocks in the portfolio. We aim for a 7-year holding period. So 35 divided by 7, you're getting about somewhere between 5 and 7 new ideas every year.
Okay.
Interesting.
Yeah, nice.
So one thing that was absent from that philosophy was the mention of small caps.
Mm-hmm.
So you guys are small cap managers. So why focus on small caps and mids if it doesn't? Why focus on small caps?
Yeah. It's a good point. Yeah. So I guess that's more a broader investing philosophy, but we have a very good reason, we think, for focusing on small caps at Fairlight. And that's because that interplay that I said before about finding great businesses and finding them at reasonable prices, you've got a much higher chance of doing that in the small cap market because they're so much less researched. There's so much less attention over them. So, people are very good at this, but am I going to be able to find something about Apple, Amazon, or Google that other people don't know?
Yeah.
Probably not.
But I'm just calling back to what you said earlier, which is like Fairlight doesn't want to have an informational advantage. It has a decision-making advantage. So wouldn't that apply?
That's a fair point. Yeah. I guess what I was saying, not as in, the products or whatever, but can I analyze or make a better decision? So many people are poring over their financial statements. There definitely isn't unknown quality, I don't think, in those businesses, right? Whereas some of the businesses that we look at that are based out in a small town in the US and no one goes out to visit them, you've got a much higher ability. Yes, there's no, everyone understands what the products are, but people might not truly understand the growth potential and the, the compounding potential of that business.
Yeah. The ability to make a better decision than the market is also baselined on like the decisions the market is making and the less sophisticated investors making decisions that you're competing against.
Yeah, I think that's a reasonable way to put it.
Yeah. I don't think I put it very succinctly, but you kind of
we
kind of got the direction.
Yeah.
On the how that investment philosophy has changed, I think most self-taught investors, and I'm going to bucket Bryce and I in on this, go through an evolution when it comes to philosophy. You start by getting told to read The Intelligent Investor and Benjamin Graham, and you think to yourself, I'm going to be a value investor. And then in the last 20 years, you realize that value underperforms. And so then you decide, I'm going to be a growth investor. And then somehow you split the difference and land in the middle and become a growth at a reasonable price investor or something like that. Is that the journey that you've been on, or how has your investment philosophy evolved over the years?
Yeah, it's funny that you bring that up because it does make me think about my early days. And it's like you read The Intelligent Investor and you're like, okay, yes, what is the book value of this railroad?
Yeah, exactly.
Right? And you go, you read it, and the way he's puts it out is he goes, just go and search for a net where there's a company that has a cash balance greater than its market value.
Yeah.
And you finish the book and you're like, easy. And then you just head off to go and do that. And then you realize, well, they don't exist anymore because there's so much financial data out there in 2024 versus 1960. And so I guess the mental models that he puts in that book are critical, but the actual way of going about trying to find a railroad less than book value or a company that has more cash than its market value just aren't applicable today. And I think that's definitely, I guess, what I've changed over time and what we do at Fairlight as well, which is just trying to pay up for good businesses that are going to compound out for a long period of time. So, we're not necessarily worried about, in fact, we don't even look at the book value of our stocks, to be honest. We just want to know the cash flows, have a good idea of what the cash flows are going to be going forward. So have a good, tight probability distribution around what we think the range of outcomes are. And then, we're willing to pay a reasonable price for those businesses.
So Will, we want to close out with some key lessons that you've kind of picked up over your career in investing. And it starts with lessons around constructing portfolio for the long term. You talk about long-term investing, but we want to extend this time horizon to 30 years. If you were to set up a portfolio for a retail investor, and you can be as specific as you like, how would you go about that with a 30-year time horizon?
Yes, I strongly think good investing is simple. It doesn't need to be complicated. And so for this kind of challenge, looking at, one of my friends' portfolios or, retail investor for 30 years, I think you only need to own equities as a starting point. You don't need to over diversify into 100 different alternatives and different ETFs, etc. And so if I was designing a portfolio for myself or one of my friends for this, I think it'd be pretty simple. 1/3 the SP 500. I mean, it's the economic and innovation powerhouse of the world.
Nice.
I wouldn't bet against it. That's for sure. And the index is amazing, and you can get it at, what is it, 4 bips now?
Yeah.
3 even?
3?
Yeah.
So that's an amazing product for investors.
Yeah.
So 1/3 the SP 500. The only thing is majority of the returns are driven by 7 technology stocks, right? So you don't want to put all your eggs in your basket there. So another third, I would look for a fund manager that does more old world industrials, kind of the things that we do, but high quality businesses. So there's a few out there that do a large cap version of this. So I'm not sure if you're familiar with Fundsmith in the UK. It's a really high quality manager. Aorus here in Australia do a really terrific job of this, and they wouldn't have any overlap with those big 7, or something like Berkshire in the US. Again, no overlap with those big 7, especially now they've sold Apple. And then the last third, small caps. So we know that over a long period of time, small caps outperform large. They're a bit more volatile, so the ride is a little bit more wild. But if you've got a 30-year time horizon, it makes sense to own small caps. The issue is a lot of those indexes, a lot of the small caps are more junky securities, highly leveraged, not very profitable. And so, again, you want to be focusing on quality in that part of your portfolio as well, making sure you're just owning the best businesses. And so for that, I would use a small cap manager with a quality bias. Fairlight would be one, or an index fund that does something similar. So I think in Australia, there's QSML that have kind of that factor overlay to try and get rid of the junk out of the index.
I think that's the important part.
Yeah. And so I guess you look across that portfolio, you've got the SP 500, a concentrated high quality industrials manager, a small cap manager. There's no overlap across all three of those. I think over the long period of time, that's going to get you 8 to 12%. Pair that with a dollar cost averaging program, some disciplined saving, and I think you can generate some pretty serious wealth doing that.
Nice. That's the thing we clipped from this episode.
Yeah, that's easy. The Dowd portfolio.
No ASX 200 in there?
No.
Interesting. No.
Yeah, I mean, this is actually, I talk to my friends about this a lot, but when you think about indexes and ETFs, I always encourage people, people think about that, go and look at what's in there. And then you go, what are the top 10 stocks? And then you go, you as an investor, do you want to own those top 10 stocks? 4 banks, 2 miners, CSL, you know what I mean? And you go, if you wouldn't buy them individually, then you wouldn't buy them in an ETF because it's the same thing. And so personally, our philosophy is not to own financials, and our philosophy is not to own metals and miners. We don't think they compound wealth over the long term. And the issue with banks, if you've got a 30-year time horizon, you want businesses that are going to grow, not pay out all their earnings as dividends. You don't want the earnings back. You want companies that are reinvesting them into the business. Banks are great for kind of more your SMSF retirees who need the income to live every year. If you're a 25 or 30-year-old with a 30-year time horizon, you want no dividends. Ideally, you want companies that are going to reinvest and grow over the long term.
Yeah,
in my opinion.
Yeah. No, that's good. So you've shared plenty of lessons for young investors, but if there was one that you could, go to every school and teach every young person, what's the one investing lesson you wish every young person would know?
Good investing doesn't need to be complicated, and you don't need to be a genius to be a good investor either. In fact, it's really easy. And so if you're willing to just accept average performance using index ETFs, you can do really, really well and set yourself up just with, a little bit of planning and a little bit of thought and a little bit of research. It doesn't require looking at the market every day. You can set up your investing plan, have your indexes that you're going to invest in. And then if you just keep doing that, you can generate really, really great returns. For those of us who are more interested in beating the market or going out and investing, I think the big one is just you need to read and read a lot and stay away from, it's not, the daily news and the noise and what's happening in markets last night or what's happening in the economy last night. You need to find things that have long shelf life, so the books that we talked about, that's really the path, I think, for young investors who want to be beating the market.
And then, Will, to close, is there any conventional wisdom in the industry that you just shake your head at, you think is wrong and should be ignored?
There's a few things, that's for sure. What should I talk about today? I guess every year people talk about their macro forecasts and index targets. That's all a waste of time, in my view. The other one as well, I think, actually this is something for your listeners to think about when they look at the performance reporting of a lot of fund managers. I think you have to be really careful when you're looking at fund managers and reviewing their performance. So as a starting point, anything obviously that's gross of fees is a big red flag. So make sure you're always looking at net of fees performance. But in Australia, for some reason, we seem to have coalesced around a reporting standard. You'd be familiar with that table on fund managers that has 1 month, 3 month, 6 months, 12 months since inception returns. You'd see this every fund manager, including us, reports this way. And then you think about what's one of the biggest issues that retail investors have is it's chasing recent performance, right? So research shows that generally fund managers that do really well last year get a lot of flows in, and then that's negatively correlated to performance going forward, right? And then when you look at that table, across those kind of 6 measures you have on the front page, all of them include the performance from the last 30 days, which is the last month, but only one of them has the performance from the start. So you're structurally overweighting the most recent performance. You see it 7 times. And so, to your listeners, and when I look at fund managers, is you want to look at discrete annual periods of performance and then look for consistency. So not over 136. You want to look at last year, the year before that, and look at how consistent the manager is in delivering on what they promise.
Yeah. But you still report the other way.
If you go on our website, we write an annual letter to our investors every year, and we report financial year discrete performance numbers.
Yeah.
So we do both.
If people are thinking about that, the one person who comes to mind who does do that is Berkshire. Warren Buffett.
Exactly.
Every letter they split out each year, and so there's no double counting from more recent periods. Yeah.
Exactly. And so, there's no coincidence in our annual letter. We have the same table at the front.
Okay.
For someone who is looking to invest in active managers, what do you think is the applicable time frame to look at past performance?
At least probably 5 years.
5 years,
Yeah. Anything shorter than that, and it's really hard to get an idea of is this manager really adding value, or are they just getting lucky?
Yes.
Yeah. And you also want to see what are they saying they're doing, and then does that reflect in the numbers, and are they consistent and disciplined in doing that for a very long period of time?
Yeah. Well, Will, so much for us to all think about. This is a series is going out over summer to help people get set up for 2025, and I think some of the stuff that you've shared will certainly help people set their portfolios up.
Sell
and
the
then,
ASX.
And then maybe go to the beach for the year. It doesn't need to be too complicated.
That's it.
That's the message. That's honestly it.
That's
it. Spend some time up front, getting it sorted. Dollar cost average every quarter. Go to the beach.
Nice.
Love it.
We'll see you at the beach. But no, thank you for coming in and sharing it all with us.
Thanks, Will.
Thanks for having me.
Now, before we go, we'd like to say a big thank you to Viola Private Wealth for supporting this series. Illiquid investments require both insight and careful planning. Viola Private Wealth's proven expertise and personalised strategies empower clients to maximise the potential of these assets within their broader portfolio. So for more information, head to violaprivatewealth.com.au.
Now, stick around because we have one more episode of this summer series to go. We're going to be speaking to Mark LaMonica from Morningstar. And I think Mark has the clearest investing goals that I've come across.
Yeah.
And the most well-defined strategy associated with those goals that I've ever seen articulated.
Yes.
So if you want to understand how you can have real clarity of purpose when it comes to investing, make sure you're subscribed wherever you're watching or listening to this episode, because the Mark LaMonica one is not to be missed. And if that's not enough of a sell, he also tells us why he'll never own Australian residential property. Pretty good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.